Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you accelerate your dreams. Today, portfolio manager David Wolf discusses the results of the U.S. presidential election, as well as the Fed's latest rate announcement and what it could all mean for the markets. David emphasized the importance of staying grounded in the investment process and highlighted the positive macroeconomic outlook in the U.S. with growth, declining inflation, and stable employment. For him and the GAA team, they were overweight in equities going into the election, and they will continue to stay grounded in this process. Here's Pamela Ritchie with more. This podcast was recorded on November 12th, 2024.
Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. The Federal Reserve has cut its key interest rate by 25 basis points. This is almost old news, but we are going to dig into it right now. The rate cut follows a larger 50 basis point cut in September, and it reflects the Fed's renewed focus on supporting the job market as well as fighting inflation. With Trump securing a second term in office, how might this impact Fed policymaking going forward? And what ultimately does this mean for Canadian investors? I have to say, joining me now here today to unpack the latest Federal Reserve rate announcement and his perspectives to glean them on the global economy is Fidelity Global Asset Allocation Portfolio Manager, David Wolf. David, great to see you.
You too.
Thanks for joining us here today. Let's begin with, was it actually a bit of a brand new world 24 hours later, sort of 36, 48 hours, when the Fed had to make its announcements, press conference, and Donald Trump had won the election? Was the Fed set up for a different world?
Well, so what I would say to that is it was a new world for the Fed and for the rest of us, not only in the United States, and certainly those of us involved in financial markets, but also otherwise. What exactly that new world looks like and will look like remains to be seen, and that's something we can spend some time talking about today. But the Fed was sticking to its discipline, which we do as fund managers as well. We'll talk about that. But to say U.S. economy a little slower, but still doing fine. Inflation has come down very nicely, and so they can cut again. Whether they're going to keep cutting, how much they're going to cut, et cetera, depends on a large number of things, not least the policy consequences of the election.
So when we take a look at the cut that was expected, the thing that came out of the press conference really, because it was so expected and baked in and everyone understood it was coming, seemed to be more of an HR question of whether Donald Trump would let Powell stay on. And, Powell was asked a lot of questions about that, and there were responses and so on. I don't know. I'll ask you because it was a headline. How material is that to the way we need to think about things? Is it?
So the chair was right in that the Fed chairman is put in such a way that they really can't be fired, but can't be, and the new president don't necessarily get along very well.
You mean the phrase can't be?
Yeah. I mean, when the chair stands up and says the president can't fire me, if you're, Donald Trump, maybe your reaction to that is, are you sure? I mean, we don't know. And that's kind of one of the broader points maybe to make today is we are in a new world with respect to policy and how governance in the U.S. respects the norms, the traditions, structure, and even the laws that are currently in place, which is a bit scary. So for us, and maybe to immediately get it in terms of thinking about investments, and obviously I'm responsible for multi-asset funds and their positioning. And so what we do, and
that's 60 billion, roughly?
Closer to 95
closer to 95.
And that's not just since the election. That's
Holy smokes. Okay.
But it is one of the things that's really important for us, and I think this will be true for the Fed, and you saw it, and for a lot of other folks, is to stay grounded in your process, because there's a lot of head-spinning stuff going on. There are a lot of headlines you can get knocked to and fro. There are things you can be afraid of. So what we have done, and let's go back maybe a week ago in terms of going into the election, we were anchored in our process to say, okay, when we look at the four pillars that make up our process, the macro, the bottom-up, valuation, and sentiment, where are we and how should we be positioned going into the election? And so our thoughts were as follows. So number one, the macro. look pretty good in the U.S.
Right.
Economy growing, inflation coming down, maybe a little bit softer and rising unemployment, et cetera, but nothing severe. So that was pretty good. Think about the bottom up, and that's all of the intelligence that we're getting from our underlying equity PMs, fixed income PMs, all the analysts collecting up the information they're getting from companies on an industry basis, et cetera. That'll look pretty good too. I mean, uneven, which is always going to be true, but we weren't detecting the, oh my God, growth is slowing, we're going to have to fire a bunch of people, batten down the hatches. That's the kind of story that you expect to see in the lead up to recession. We weren't hearing any of that. Valuation in the US in particular with respect to equities was fairly elevated. But when you dig into that, it was really the very top end of the market, the so-called Magnificent Seven, where you saw those elevated valuations. And we would stress test this basically every week with our analysts to say, those who are covering those companies, do they think that the longer term earnings outlook for those companies justifies these elevated valuations? And the answer kept coming back, yes.
Right, even though earnings showed a few wobbles and reactions. But
yeah, I mean, you're looking beyond 6 months, 12
Exactly.
months, what have you. And these are folks that know these companies and talk to these companies more than basically anyone in the world. So that, we'd rather buy things cheap than more expensive, but that didn't seem to be a barrier to things doing better. And then the final pillar, sentiment. So this is where the election really played in. So sentiment is a contrarian indicator for us, which is when everybody is on one side of the boat, we want to be on the other side of the boat. And so be greedy when others were fearful and fearful when others are greedy. I think that's Warren Buffett. Mm-hmm. And so what was pretty clearly the case going into the election is there was a lot of fear. There were folks who were hanging back on the sidelines, didn't know what we were going to get, didn't know how long it would take to figure out, who was going to win and what the consequences were or what have you. That uncertainty was clearly hanging over the market. And the one thing that we were sure of, because obviously we didn't know who was going to win the election, what have you, is somebody was going to win the election, and that uncertainty was going to clear. And unless it was a really adverse result from an economic and policy point of view, that was going to catalyze a lot of this money that had been on the sidelines to come back into the market.
Right.
So when we put it all together, it all looked pretty good. So we were content in not being scared, so to speak, and grounded, anchored in our process to say, we are happy to have an overweight to equities going into this. And obviously we've engaged with that since, where markets have done quite well, particularly in the US, and that's really helped performance in the funds.
So to an extent, the way that you walked into the election in terms of those four pillars and grounded in your process, looking about the same right now?
Broadly, I mean, so we have a clear outcome.
Yes.
And we have what seems to be a red sweep, although the House remains to be sort of fully called. And so the question now, and our research people have prepared us very well for this, is what does that mean in terms of policy, in terms of impact on the economy, and ultimately impact on pricing in financial markets? That's not as obvious as kind of we would want. And one of the reasons is when you take Donald Trump and you take the sort of policy measures, what he's talked about primarily is tariffs, a bunch of other stuff, but really when the rubber meets the road with respect to the economy is tariffs. But what's not clear there and elsewhere is he going to do what he said? Can he do what he says? Because, there are outlandish things like we're going to put, 100% tariff on Chinese. We're going to make the Chinese pay. That's not how tariffs work, right? So, a tariff is a tax on imports. Yeah. So if a company wants to buy supplies, whether it be toys or equipment or whatever it is from China, when they import it into the country, they have to pay the tariff 10, 20, 50, 100%, what have you. So China's not paying. It's the company that is importing the goods that's going to pay. On this side, yeah. And then ultimately some of that is likely to get passed on to consumers. So there's an inflationary impact there, which the bond market is internalizing now, because even if stocks have gone up, bonds have gone down. Right. So interest rates have tended to go up despite the Fed's cut. But we don't really know, because one thing that it's pretty clear that the incoming president doesn't want to do is crash the economy. And if you put on really heavy tariffs, you're probably going to crash the economy. So where exactly that ends up, we don't know. Nobody else knows either. But it's something that we're mindful of in terms of crafting our positioning. It means that we're still wary of fixed income at these levels. Yields have gone up. It's not clear that they've gone up enough to compensate for those higher inflation volatility type risks. But the equity market environment in the U.S., and the story is different in Canada and different still in Europe or Japan or emerging markets or what have you. In the U.S., markets are reacting positively from an equity point of view. They're probably right to.
So, that leads you to wonder if you could jump to there is no alternative. It's the U.S. dollar, which is on fire, so hard to argue with that, and therefore equities. Why or why not does that sort of seem like a useful way of looking at the world?
Well, so unlike maybe a decade ago where you did have this TINA phenomenon, like you have to be in U.S. equities, there are actually plenty of alternatives these days. So that was a period of time, if you go back a decade ago, where interest rates were basically zero, right? And the U.S., particularly the equity market, was the only game in town. So there really was no alternative to being involved there. Now you have alternatives. So bond yields are 4 or 5% rather than 1 or 2%. You have EM, EFI, Canada even, that are super cheap.
Looking? Yeah,
but it's not great, but they're also a lot cheaper. And everything is for the price. So maybe to step back a sec, as you know, we've been concerned about the Canadian macro environment for quite some time. We've been concerned about the TSX. We've been concerned about the Canadian dollar. We've generally been underweight Canadian assets versus the U.S., which has been the right way to be and has helped performance in the funds, et cetera. And so one of the questions I'll often get is, when would you buy Canada? What would make you not bearish on Canada? When would you go overweight Canada? And the answer is really the price. And that's a good way to think about markets generally at this point. Like, if everything was the same, if the world looked the way that the world looks, but Canadian dollar was 55 cents and the TSX was 30% lower, we would be buying all we could of it, right? So it's basically, are those risks and is that outlook discounted in the price? And what we've seen over the past week or so with the divergence between the US dollar and the US equities getting stronger and Europe, Japan, China, other markets getting weaker is you're discounting that divergence in the outlook. Sometime that will be too wide. And even if the outlook in Europe is terrible, if it's cheap enough, that market can work. So it's one of the reasons why, for the funds that I'm responsible for, we're never only invested in the US or Canada or Europe or what have you. We have this diversification across geographies, and then we'll tilt them depending on whether we think the price is right in terms of taking the risk in a given market.
So let's push further on that Canadian thread there. Are things about to get so much worse that the price will look good?
So we are still underweight Canada, which implicitly means we think there's further for the Canadian dollar to fall. There's further underperformance to come in terms of Canadian assets, and exactly how much we'll have to see. Canada occupies an interesting spot here in the context of the election, because if you're the U.S., the consequences of this more insular U.S. policy, America first, is probably good, and markets reacting that way. If you're China or Brazil or Germany, probably not that good, right? Canada's somewhere in between, right? So we are closer to the U.S. geographically and also economically. But the question is, and it's kind of a microcosm of what's happening globally, how much does Canada benefit from that relationship? Are we going to be exempted from tariffs? Partly exempted from tariffs? Not exempted at all? We have the USMCA that's coming due for renegotiation, I think about a year and a half or so. So that's a question. Does it get ripped up, et cetera? So none of these we have answers to, and I don't think it's because we just don't know. I don't think anybody knows, including the administration, how they want to play it. So we'll see. But one of the things it does is it sort of adds to the near-term challenge in Canada, because you think about if you're a global company and you want to build a manufacturing plant or you want to invest more generally, and you don't know if Canada is going to have access to the US market, you're not going to go guns blazing billions of dollars into Canada, because by the time you're finished your project, you may have this, you wanted to supply the US, now you can't supply the US. So the Bank of Canada, for example, and I think other forecasters are expecting an investment boom as part of the recovery in the economy. And this is the kind of thing that makes you think we're probably not, the uncertainty is such that it's not clear businesses are going to be as willing to invest as they would have been 3-6 months ago.
Is there something to the difference in the business tax, the corporate tax story? So tax cuts on a corporate basis in the U.S. under a Trump administration, we think will be slashed. That's one particular election promise and discussion. And it was always a bit of a struggle competing in Canada on that basis as well. But if they drop from sort of low 20s to the 15-16% range in the U.S., how consequential is that for Canada? That sounds pretty bad, actually.
Yeah, I mean, it's all, depending on the degree, right? Like corporate taxes, generally speaking, are already lower in the U.S. than in Canada. It depends on the sector. It depends on the breaks that are given or what have you. And but the more that gap widens out in terms of the advantage of being located in the U.S. and whether that's corporate taxes, whether that's tariff barriers, what have you, the more that Canada is going to be disadvantaged. And one of the concerns that you have, and we've talked about this many times over the years, is what else is there for Canada? Because the foundation of this economy for, going back a couple of decades has been domestic demand, and particularly consumer spending, housing, and debt taken on to fuel that growth. That's going away, and it's going away, and we can unpack that to some degree, but it's already kind of gone away. Right?
Well, that's really interesting. Yeah, carry on. I have more to ask on that.
Yeah, so it's already kind of gone away. So what's going to replace it? And if you're hoping that foreign demand is what replaces it in terms of being able to export more to the U.S., now you have a fly in the ointment, so to speak. So it doesn't. The Canadian macro environment was vulnerable, shall we say, and is no less vulnerable today than it would have been a week ago.
Bill often say that necessity is the mother of invention. We sort of heard that about Canada being able to diversify industries, and it has to a large extent. I mean, it has certainly for a long time. Is there something in this impetus where there will be more of an impetus to get even more innovative here, because we have to in order to compete? I mean, and again, we're cheaper. You could. The hopeful thing with the low loonie is that yes, will be great for the exporting story, but I don't know. You have to work hard at that.
Yeah. So a couple of things to mention on that front. First, with respect to the currency, so if the border is thicker, so to speak, if we have less access to the U.S. market, and if we have something of a hollowed out kind of goods producing sector in this country other than the commodities particularly. So even if the border wasn't thicker, it's not clear that we just have enough capacity anymore manufacturing wise to actually sell into the US. So what that's going to tend to mean is the currency will actually have to go down more than it would have had to previously in order to stimulate that kind of export demand. And again, the level is not clear. The other thing sort of to keep in mind with respect to this is Canada, one of the big stories has been immigration, and the flip side of that has been productivity. So a way to talk about that is we've obviously had this big surge in population that's been good for the labor force in terms of size, not necessarily output, but productivity has gone way down. And one of the reasons productivity has gone way down is the same side of that coin. Housing has been where all the capital has flowed, and that's long predates this surge in population. Housing is a fundamentally unproductive asset, right? So you haven't had the kind of expansion of business investment, the investing in innovative companies that would tend to drive the economy forward and get productivity up over time. So not only do you have the pressure, and I know we're pulling together a few different threads here, not only do you have the pressure on innovation from more difficult access to the U.S. market, but you also have the pressure to do it because housing is not likely to be as fruitful going ahead if nobody's allowed in the country, right? And so that...
They say there's lots of demand anyway.
Well, and that may or may not be true, but the point of it is that the economy is going to need to reorient away from just building houses to investing in productive industries. And the pressures are there from thicker border and from lower immigration. to the extent to which it actually manifests itself, like how much we can engage in this, again, remains to be seen. But it's a challenge. There's no question it's a challenge, and it's not going to be fixed today, tomorrow, next week, next year, what have you. And one of the things that we observe historically, and this is not just true in Canada, is whenever you have these big adjustments in how an economy needs to operate, there tends to be a period of transition and adjustment, and that tends to be not so good for growth rather than good for growth as you retool, so to speak. And that's, I think, one of the things that we face in Canada.
So we might have some more rate cuts.
Yeah,
I mean, we were always going to, but it sounds like there's no reason to slow down.
and that maybe is where the rubber meets the road. I know I've used that phrase already, so maybe there's a lot of road and rubber. I
another one.
don't know what the analogy is. But that's kind of where it all comes together in terms of thinking about the exchange rate, interest rates, economic growth, inflation, how it feeds in. So the way I would put it is neutral interest rates in the US are probably higher than neutral interest rates in Canada. And that has to do with underlying activity, productivity, capacity in the economy, debt levels play a role there as well. So US neutral interest rates, say, are here, Canada is here. Then you think about where is the economy in the cycle, and in the cycle in the US, things are pretty good. In Canada, we know we have a huge mortgage payment shock coming. We know that rates need to get to below neutral. So neutral in the two countries is here, and then cyclically you want to be above in the US and below in Canada. That gets you a very wide interest rate differential in favor of the US dollar. It's a wider differential, I think, than markets are currently discounting. And it's one of the reasons why you can expect the Canadian dollar depreciate over time, because the short end spread is, I think it's a little over 1% right now. We've seen it as wide as 2.5%. If we go back to the mid-90s, we could very easily, in my mind, get there again.
See that. Wow.
Yeah.
Well, and there was a big debt story in the mid-90s for Canada then as well, which...
That's not coincidence.
That's not, yeah, I'm sure that's not coincidence. This question here, but then I want to ask you, let's go to this question first. So do you think that Trump's policies may drive up, see, we've got more rubber road things, drive up inflation, resulting in the Fed having to cut rates? Do you think that drive up inflation, resulting in the Fed having to...
Probably having to raise rates.
I think raise rates, yeah.
I get confused sometimes too.
Yeah.
Not with respect to the funds.
Yeah. No, I think they meant raise.
Yeah. So, tariffs on their face are inflationary, and against the backdrop of a reasonably strong economy, yes, you can expect some higher inflation. If it's sufficient, the Fed would say, let's stop cutting. And you could even turn around and have to raise rates. Again, the environment in Canada is really different.
Right.
Because yes, you would see some uplift from higher goods prices, for example, in the United States. But one of the things you'd also see is because of the soft economy and because of the declines in immigration and population inflows and that sort of thing, the only thing that's currently holding Canadian inflation up is shelter prices. So if you take shelter out of the CPI,
things are kind of okay.
Canadian inflation is zero.
Yeah,
right?
It's amazing.
Shelter is about 4 or 5%. But then if you look into the details of that, you say, okay, well, shelter, two of the biggest components in inflation in shelter are mortgage interest costs, which are starting to come down and will come down considerably further. How fast and how far is not clear, but they will come down. And rent. And rent is going to come down too. In fact, it already is.
It is already.
And that has to do primarily with the population inflow immigration story. So in some cases where you've had, for example, a lot of international students and university towns, new rents are 25, 30, 35% lower. Now it takes a while for that to get into the inflation numbers because you're looking at overall rents and not just new rents for properties. But that's going to be coming down too. So you can paint a picture in Canada where CPI inflation, excluding the shelter piece, stays at zero. That depends on a few things, but that's not an unreasonable thing to say. And that shelter actually flattens out as well because interest costs are coming down and rents are coming down. And so you end up with a CPI inflation rate in Canada of zero. And if you have a CPI rate of zero and you have a soft economy and an elevated unemployment rate, Bank of Canada is cutting a lot.
They're cutting a lot, yeah.
So even if the Fed isn't really doing anything, the bank is cutting a lot. It ends up in the same place, which is we need lower interest rates in the United States. And that means we need a weaker currency than the United States, and I think we're going to get it.
Well, it's this voice of calm and reason that's gotten you through, a big catalyst in the markets, and actually has led to some performance. I think you mentioned, have you been working on which fund for 11 years? This has been your best year, very best year.
Yeah,
right?
so as you know, we have a set of different multi-asset funds, the largest of which is the Global Balanced Managed Portfolio. It's about a $22 billion fund right now, and I've been on that fund for over a decade, and this is the best year we've ever had in that period of time.
Congrats.
Now thank you. I mean, that has a lot to do with what's been happening in the market. So equities are up, bonds are generally speaking up, but it also has to do with the outperformance that our underlying managers have been able to deliver, and what we've done in terms of asset allocation tilts to add performance as well. So, it was 2022, if we go back a couple of years, was thought to be kind of the death of 60-40, and both went down. You had double-digit declines. It was pretty awful. It's come roaring back, and it sort of speaks to the strength of that structure and diversification to say you want to be involved in equities, but you need to have other things too for times when equities don't do quite as well.
Amazing. Well, congrats on that. That's sort of amazing. What would you say is the biggest story thus far of the year? We're not finished yet, but I mean, the election seems obvious. We knew it was coming on some level. The rate story has been wild because we started with expectations that were just so off. And here we are now, where we've had some rate cuts. This is the U.S. rate cuts. What do you think is the biggest story? Maybe it's a story we don't even think of or pay enough attention to. But for you in the markets, what would you say?
I would say we've had enough stories for a year. I'm okay with not having any more stories for the last few weeks of the year. Now, it's been an active year. It's always an active year. But I think one thing that we did, and this is going back about a year ago when folks were still talking about, are we going to have a recession in the United States? Are we going into the end of the cycle? Are we going to, should we really be pulling back the reins, so to speak, on our risk? And we did the opposite. And we wrote a paper, I think it was last October, called Potential, where we laid out the argument for, well, actually, there are some very good things going on in the U.S. with respect to productivity, with respect to the labor force, and that's not just immigration, but it's also more flexible working, which has been amazing, just as a slight aside at this point. More flexible working arrangements, work from home, blowing up the 9-to-5 paradigm, has been fantastic in terms of bringing people into the labor force. So particularly women with children and the disabled in the United States, you're talking about 4 million more people who are able to work now than were working before. And there are a few reasons for that, but I think the biggest has to be that there's more flexibility in working arrangements. So that was another thing really adding to capacity in the US. So what we basically said is there are good things going on with potential growth, capacity in the US, which means the economy could keep growing and inflation could come down. And that's something that the markets would cheer. So we put on a fair bit of equity exposure about a year ago based on that view. And so we were able to engage with the improvement in markets over the past year that I think a lot of folks and a lot of competitors have done. And that's one of the reasons why we've seen the results that we've seen.
Fantastic. Give us sort of a 1-minute discussion of the allocation that's there right now. I think you just kind of...
You know me very well, Pamela. Can I keep anything to a minute?
I think...
Now it's like 45 seconds, right?
You to, yeah.
Yeah, so we're overweight equity still, and we haven't really changed that in the last week. We're very deliberate about that anyhow, but things still look relatively good. We're underweight Canada, as I mentioned. We still have overweights in the US, but also in Europe, Japan, and emerging markets. Again, the outlook there isn't so good and is even less good than it was a week ago, given the election policy changes. But they're very cheap, and there are a lot of opportunities that our underlying managers are finding in terms of individual companies there. And then on the 40 side of the portfolio, so to speak, we're quite underweight investment grade and government bonds. We still don't think that these higher rates are necessarily high enough. And we're still diversified in terms of credit exposures, and that includes things like emerging market debt, which is also really cheap. And as we've talked about before, alternatives, which we think are a rich vein for diversification in this kind of environment. We've moved in there in terms of liquid alternatives as well as a new Canadian real estate capability. And that's somewhere we're going to work further going on ahead to make sure that we're properly diversified in case equities aren't working. They've been working, and everybody hopes they keep working. But we also want to make sure we're diversified so that when they don't work, and there will come a day where they don't work, that we have other things in the portfolio that can sustain us through that period.
David Wolf, we're glad you're at the helm. Thank you for joining us here today on Fidelity Connects.
Thanks, Pamela.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.